In The Intelligent Investor, there are 7 key criteria that are meant to be used to find good companies to invest in. And in this video, I'm going to conduct a search for any and all stocks that meet all 7 of those criteria heading into 2022. These are the 7 things that the author of the book, Benjamin Graham, said were important to consider when looking for companies to invest in. And don't worry, I'll explain each of them briefly as I apply these criteria to my search. Since Warren Buffett followed the principles in this book to become one of the most successful investors ever, I thought it would be interesting to see what companies today, if any, actually meet these criteria. So without any further ado, let's get into it. All right, so here is my stock screener tool. And as you can see, it starts off by including every single company in both the US and Canada. But as I add additional search criteria to this, the number of stocks that are left is going to dwindle. And the first thing that we're looking for is company size. And this is meant to weed out penny stocks or small companies that don't have the staying power of large established organizations. Now, the 2006 version of the book said that you shouldn't invest in companies that have less than $100 million in annual revenue. But to account for inflation in the past 15 odd years or so, I'm going to raise that figure here to 150 million. You can see that we're starting out with over 9,000 companies, but as soon as we add a minimum revenue per year of 150 mil, we're automatically left with 4,372 companies. So we've cut it in half. Next up is current ratio, and this is a comparison of a company's short-term assets to short-term liabilities. And the book suggests that you shouldn't invest in a company that has less than a 2-to-1 current ratio, or $2 worth of current assets for every $1 worth of current liabilities. And as soon as we apply that to the stock screener, you can see that we're already down to 1,367 companies. So each time we add something new to this stock screen, we're left with fewer options. The third criteria, according to The Intelligent Investor, is a consistent record of paying dividends. Now, the book suggests that you shouldn't invest in companies that haven't paid a regular dividend for at least the last 10 years. But with my stock screener tool, the closest I can get to approximating that is the dividend growth rate 5-year average. So I'm going to apply that to the screener and put it at 0% or higher, meaning that the company should be paying at least some dividends and that it should at least not be decreasing every year. I think that fits the bill and it covers a 5-year period. And with that, we're down to 252 potentially investable companies. For number 4 and number 5, I'm going to combine 2 criteria because there's 2 that are linked to a company's earnings. The first is earnings stability, or at least some earnings per share over the last 10 years. And the second is earnings growth, or at least a 33.3 or 1/3% growth in overall earnings over the last 10 years. And in the stock screener tool, I have a criteria that's earnings per share growth 5-year historical. I figured this is as close as we can get, and if we're seeing earnings growth every year for at least 5 years, then we're also seeing earnings stability. Now, since this is only for 5 years, instead of the recommended 10-year period, instead of applying the 1/3% growth over that period of time, I'm going to apply a 15% figure. And with that, we've dropped another 200 companies or so, and we're down to 58. The 6th criteria is the price to book value, and this compares the valuation of the company to the value of all the assets on that company's books. And to clarify here, the higher the ratio, the worse. So a company that has a very high price to book value ratio is potentially overvalued, and the lower the ratio, then is potentially undervalued. Now, in the book, they suggest that you shouldn't invest in any companies that have a higher ratio than 1.5 to 1. So we're going to apply that here, and with that, we're only left with 4 companies. And the 7th criteria is price to earnings, kind of similar to price to book value, but instead of comparing the company's valuation to the value of its assets, we're comparing it to its actual earnings over the last year. Again, the higher the PE ratio, it means that the company is potentially overvalued, and the lower, the more undervalued it might be. And the Intelligent Investor suggests that you shouldn't invest in companies that have a higher PE ratio than 15-to-1. So when we apply that to the stock screener here, we're down from 4 companies to 3. So after starting with over 9,000 potential ticker symbols, when we apply all of the criteria that the Intelligent Investor says you should look for when making an investment, we're only left with 3 companies. And those 3 companies are MDC Holdings, Sentiment PLC, and Rocky Brands Incorporated. Now let's look a little closer at what those companies are and see if they actually make sense as investments for 2022. First, we have MDC Holdings, which was founded in 1972, and basically they're a home construction, home building company. The stock is currently valued at just over $50 US per share. And if we zoom out to see the performance of the company, you can see that over the past 5 years or even longer, it's had a bit of a rocky past. It's definitely not a straight shot up like, for instance, the S&P 500 is. Now, that doesn't mean that this is not a good investment moving forward though. And in fact, the whole point of these 7 search criteria in the book is to find companies that are currently undervalued, that the market isn't paying enough attention to, and that aren't getting their fair due. And as we can see here, this company has a PE ratio of 6.63, so it's very, very reasonable by today's standards, where some tech companies especially have PE ratios in the hundreds. They pay a very healthy dividend of almost 4%, and it is a very large and well-established company with a market cap of around $4 billion. And if we look at the company's recent third quarter earnings report, they're doing very well. Sales are up 26%, profit margin is up 3%, and overall things are looking good. Next, we have Sentiment PLC, and this is a gold mining company. Its headquarters are in Australia, but it looks like it also operates in the UK and in Africa. This company is a little bit smaller with a market cap of $1 billion, and the shares are trading at $1.57 currently. If we look at the 1-year chart and the 5-year chart and also the all-time chart, you can see there's quite a bit of volatility with this stock. Now, whether or not this stock is a solid value play, I haven't done enough due diligence to tell, but just from the basic facts here, the revenue of the company in 2020 was just under $1 billion, and the market cap of the company is just over $1 billion. So there, we're not really seeing a big differential in the price to earnings ratio. Also, the net income of the company over the same period is $315 million, so that's a very healthy profit margin. If we go to the investor relations tab of the company's website, you can see their EBITDA margin is 52%, so very healthy. And the third and final company that made it all the way through the stock screener is Rocky Brands, which is an apparel company that makes boots and other work apparel. It was founded in 1932 in Ohio. And actually, yeah, looking at their website, I do recognize some brands that I'm familiar with. This is by far the smallest of the 3 companies on the list, with a market cap of $250 million. The PE ratio is just below that threshold of 15-1 that we were looking for, and they do have a dividend of slightly less than 2%. If we look at the performance of this company over the last little while, actually, they've done quite well this year. But aside from that, it has been a little bit of a rocky history. Get it? Anyways, those are the 3 companies heading into 2022 that meet all 7 of the criteria laid out in The Intelligent Investor. Now, whether or not these 3 companies are going to be good investments for the future, I can't really say. I guess it just depends on if you believe that value investing is still alive and if these criteria are still relevant today. Looking at the performance of these companies over the past few years, they've definitely underperformed the market, and you would have been much better off taking your money and putting it into an index fund. That said, it does not necessarily mean that they won't outperform the market moving forward. Anyways, thanks so much for watching. I hope you found this entertaining and potentially helpful, but remember to always do your own due diligence when making investing decisions and potentially consult with a certified financial advisor. Thanks so much, and I'll see you in the next one.